As for Investopedia, and as I present these slides, you can read along, and I won't actually talk slide word for word. There are some points though that I am going to state outright that I believe you should remember. Now, you might not remember everything that is stated here, and the video we will put up afterwards, but there are some key points that I want you to remember because you're going to hear it over and over again. So, as per Investopedia, as it says, basically value investing is an investment strategy where we pick stock that is trading far less than what is termed its intrinsic value. Now, that term is bounced around a lot, and it gets more complicated based on who you're speaking with. But in my studies of it, not just by this definition of Investopedia, but in the books that I've read, intrinsic value really maps back to what is the terminology book value of a company. And we will get into that later on, so you don't have to fear about that. So for a value investor, we are always actively looking for companies. I put stocks there, but really and truly what we look at is companies, right? That we think the stock market is underestimating. And more importantly, we look for the companies after we've analyzed them, evaluated them, that we think people are going to overreact about. So that's when we make our moves, or we make our moves before that. So when people overreact to good or bad news, let's say they overreact to bad news, and that pushes the thought process behind the company downward. We know what we know in terms of what we've done, and we then decide to capitalize on that. If it's good news and it pushes the value by the person's upward, then we also capitalize by basically deciding, well, we're going to sell and take some profit, right? So the truth is, what happens in the stock market and about a company on the stock market when you hear or you see the price of the company go up or down has absolutely nothing to do with the company itself and how its performance is going on. The company has already come to the stock exchange. It's already listed publicly. It's already taken the money that it was planning to list. And unless it's coming back to the market for more money, you moving, buying or selling has no influence on the company. It doesn't affect the company's ability to keep operating, right? So for us, for the regular investor, value investors thrive on what and no disrespect to anybody, but the regular investor and or trader based on their overreaction to information. So as I said, when prices jump sky high, we take profit. We're exiting when people are entering, and vice versa. When people are exiting because they're afraid of some bad news, that's when we're entering because we've done what's required to find company. So our goal is to always pick up the company at a discounted price, to buy low and to sell high. And that's really what all investors do. But value investing goes out of its way to try and make sure that you find the company or that stock price, if you're going to enter in at a discount, at what we deem a discount or term a discounted price. So value investors like analysis. They analyze everything. And if you're going to do value investing, I'm sorry to say, there's no other way that you're getting around this other than get comfortable with wanting to analyze. If you don't, I would highly recommend, I even highly recommend without that look, if you are not understanding of what you're buying, you give your money to a credited investor or broker, what you would call a licensed broker, because that should be the safest place that it is. They are licensed to give you that information and tell you and suggest to you, what you should go into. But for value investors, we do our analysis, and there are two types of analysis we do. It's quantitative analysis, which basically is analysis around numbers. So it's around what you guys always hear about. I believe you should have always heard about financial statements of companies, right? That's what they do every single year. they have to put out. All publicly listed companies must put out their financial statements. And then the second part is qualitative analysis, which is, again, looking at the financial statements, but also looking at news around the company, things that happen. So we listen to what the directors and chairman of the board of the companies, etc., the managers are stating, because that presents opportunity for us as well. I have seen it though more present the opportunity where the stock price might dip and it might allow for us to buy more, which is good. Otherwise, so those are the two: quantitative analysis, which deals strictly with the numbers, and qualitative, which deals with word of mouth, or what people are saying, what the leaders of the company are saying, and the auditors as well too. That's very important. So we also, sorry guys, we also look for possible trends. That's another, well, what I have read, I should say again, in my opinion, the books that I've read so far, we look for trends. So we basically take all of the information, string them along for X amount of years, and we see how those trends develop. Now there's a statement that is made that if you've read some value investing books or investing books in general, there's a very, very prominent statement that says past results does not dictate the future. While true, because anything can happen. Take the situation right now that we're in, unfortunately, with COVID-19. I have found that if you've picked really good companies with solid financial backing, sound foundation in terms of how they're operated, how their leaders carry them out, then those companies weather storms. Not only do they weather storms as well, they also are able to take advantage of a crisis. So that's for me, that has been one of the best things of value investing. That when you find good companies make moves at any point in time. They make moves when things are not that favorable for them, and they make even bigger moves when the situation is favorable for them, right? And it's just to know what you're looking at. So as I had skipped ahead to that cartoon that's coming up, what value investing allows us to not do is pretty much this. We are able to tune out the noise. So you might have been looking at what's going on in the world today. If you follow avidly the financial news, today the stock is up, or the market is up today, tomorrow it's down. It's bouncing around, and this is exactly what it is. You notice his face. His face is one of worry, because he can't tell what's really going on. For a value investor, we sleep soundly at night, knowing that what we've done, the companies that we've analyzed, and the investments that we've made, whether they go up, if they go up, great. If they go down, we're confident that they are more than likely going to be rebounding with time given, right? So this is what we as value investors try not to be a part of. We try not to be a part of listening to the noise. So another important part that I wanted you guys to have from my presentation is outside of the information that I'm going to provide, reference information is very important. So if nothing else that you take away from this, please take away that for me, I use investopedia.com for everything investment related. It's basically like my encyclopedia. Yes, they show a lot of stuff about news. They will give you the happenings financially going on around the world. But any concepts, any piece of information that you hear, persons and the concepts that I'm going to use, the terminologies, that's the better word, that I'm going to use here, all of them are well described in Investopedia with videos and breakdowns, even much better than I actually will do it justice. For Jamaica, for those who are in Jamaica, your next best place to go to is the Jamaica Stock Exchange as well too. That's where you're going to have to go to for your company information. But Specifically, let me break out for a second, not just the Jamaica Stock Exchange, but a specific part of Jamaica Stock Exchange. So when you go on the Jamaica Stock Exchange website, JamStockX, the part that you want to really focus on is your company, the company information, which is down here in lookup instruments. And I'm just going to pick a random company. This is not any by any choice, it's just there. And it will take you to the company's performance page, basically, right? And in that section, there are 3 areas you want to focus on. At least I focus on. Focus on the audited financial section. That is where the financials are put out for, this is normally for the year. Yeah. And it's just for the information from the audited financials of itself. It has no report from directors or anything like that. It's just auditors review and the numbers, financial statements. Then there's the annual reports. That one has all of the pretty pictures and people smiling and showing off the products, and that will have the information from the company's leaders. And then you have the quarterly financials. And the quarterly financials, those get released, and I would describe it better in short order during each quarter, which is normally every 3 months. So for me, these are the most important parts about the company for the Jamaica Stock Exchange. Now I used another place, another link just now called Stock Screener, investment stock screener. So I wanted to bring that up for you. I found that this site, the Jamaica Stock Exchange, is notorious for not having a place where all of the information is collated together. So you have a difficult task sometimes to find everything in one. So you have to be going through this for each company individually. I found that this particular site, investing.com, and the particular section, which is their stock screener, has actually ingested or imported all of our companies on it. And it shows all of the information, but don't be overwhelmed by what you're seeing here. The most important part about what it has done is also put the fundamental information about the companies as well. So like, for instance, you're seeing a side-by-side of everything that is there, but if you click on a specific company, you get to drill down into it, and then you can actually bring up their financials. And you get a full breakout year on year of these companies, just like how Yahoo Finance or other websites, marketwatch.com, those are some of the examples I know, marketinsider.com would be showing you if you looked up a company. So I think this has been a great inclusion, and this bookmark will be, or this reference will be given for you to use at the end of the video, will ensure, because this is one of the places that I think you should go to outside of going to the Jamaica Stock Exchange as well, right? And the individual company. Also, you can make your life easier by bookmarking your companies that you're either interested in or you own. Just bookmark the pages so that you don't have to continuously be going to the Jamaica Stock Exchange site and then having to jump in. So, and another one is going to be a bit difficult, but the link will be left after the video. There's a particular group. We had them on, I think it was about 2 months ago. We had one of the members on, Robert was his name, from the Investor Podcast Network. Now, these guys changed my life, actually, to be very honest. When I started from a point of reading, and a lot of the information went completely over my head. They have a series of videos. The founding members, Preston Fish and Stig Broderson, did some initial videos, and that's actually the title. It starts with what is value investing. If you look up what is value investing and these two persons, you'll easily find their videos. And it goes in 3 sections. There's 101 investing. Well, I termed it investing 101, 102, and 103. And it's basically beginner, intermediate, and advanced. After you're done with this presentation, definitely check them out. You can reference them, and it will give you even more insight, because I've taken some information from them in this present and added it to my presentation to help you along, because they assisted me. So 1 second.
Welcome to Course 1, Unit 1, Lesson 1.
That's actually, so sorry about that. So what we get into now, as I said, what we look at as value investors, where everything starts was the analysis, and it starts from the financial statements. So there are 3 financial statements. They are the balance sheet, the income statement, and the cash flow statement. So as it says, the balance sheet is the statement of financial position for the company. What it basically shows is the position of the company, or the performance of the company, sorry, at a particular time, either in the year, because it's normally done either quarterly, as I said, every 3 months, or it's done at the end of the year. So there's the quarterly reports every 3 months, and they're either 4 quarters. They can either do 4 quarters, or they forego the final quarter and just do an annual report, right? So the quarters are normally listed Q1, Q2, Q3. So you would hear that terminology. You should be hearing that terminology on the news and so forth, where they say, "Oh, this company put out their Q1 financial report." So that's a quarterly report, and it will have all 3 statements, by the way, or all 3 documents, not just the balance sheet, but everything is going to be there. But the balance sheet is a statement of financial positions. It's how the company is performing at the end of that particular time, and how it sets the company up for how it should be performing going forward. The second one is the income statement, and that is the statement of the company's actual operations and the ability to generate what is called revenue, their money. And if after they've cleared all of their expenses from the revenue that they've generated, if they have a profit or they have a loss. It's as simple as that. And then the third one, which doesn't, as you notice, have an extra statement behind it or extra explanation, is the cash flow statement. Now, in accounting, people talk and say, or should I say, accountants normally term this particular document as it's like a nice to have, well, not a nice to have, but it links together information between the balance sheet and the income statement. But for a value investor, it is the most important document from my readings that I've come across. Why is that so? Because you might see terminologies in the balance sheet and in the income statement that don't actually have a cash value behind it, or should I say, not a cash value, but it might be an estimation. That's the better way to describe it. The cash flow statement does only one thing. It deals with money coming into the company and money going out of the company, nothing else. Right? So it is absolutely very important for a value investor, because what we look at is in a company. If you've ever heard the terminology, you can hear it now again. If you've never heard it, you hear it now first time. Cash flow is the lifeblood of any company. Without it, the company will die. It can't operate. So you need to be able to identify how cash is flowing through the company, in and out. And the beauty about the cash flow statement, again, as I said, is it only deals with cash in and cash out, actual money. Has nothing estimated in it, at least from what I've seen. As I stated, the 3 statements, when they're produced during different periods of the business's operate. They call it the operational cycle, or its financial year. For its financial year, as I stated, you have the quarters, and then you have the end of the business cycle, which is for the year, right? You have a final document that is done for the year. So all the takeaways, regardless of what has been said, 3 things you need to remember. The 3 most important things about the financial statements are: you need to focus as a value investor on the balance sheet, the income statement, and the cash flow statement. That's where you are going to be most of the time. right? In terms of analyzing a company and seeing if what you are hearing from pundits and the stock market and etc. is actually matching up, and if it makes sense truly to buy this company. So, as I said, we won't have time to really get into all of them, but everything starts from the balance sheet. So I wanted to start with that first. Actually, this one works properly. So the balance sheet, as you know, I just said, it's a statement of financial position. It's the root of the business. It basically shows how the business is performing over the time. For a value investor, we can look on it we do look on quarters, or should I say, I found that yes, we look on quarters, but the books that I've read, they focus a lot more on the yearly financials, so the yearly performance of the company. And the balance sheet is basically broken down into really two sections. There's assets, and that's what the company owns, and liabilities, what the company owes. Now, if there are any accountants inside here, guys, this is repetitive, and you would know it. But for the newbies and those, you need to know this. You need to understand this. So from there, assets and liabilities, right? When you subtract one from the other, when you take away the total assets from the total liabilities, you get what is termed the equity of the business, right? Now, in the financial statements, you might see this term being listed as shareholders' equity. And this term is important, which is why I put it in those quotes, because that's the money that is for you. You, the shareholder, you, the person who buys that stock, is for you, right? It is the money that if the business was to be, and the term is liquidated, but really just wrap up the business and sell it off, right? If they're to sell off the business, this is the money that you, the shareholder, get to partake in. Once that money if there is none, you've got none to partake in. So if the company has no equity, why are you buying it like that? If equity is negative, right? Value investors like companies with a lot of equity, because we know that means there is something for us, right, to partake in. So from there, assets and liabilities are further broken down into their individual sections. Now, I have not pulled out all of the things that are in a balance sheet. I've only pulled out what I believe to get you guys started are the most important things, because this is, if you were to try and visualize, I guess not really a tree, but a tree growing. It starts with the roots, and then you finally get the leaves on the branch. But look at it as basically an upside down, I guess an upside down tree, or top down. So for the balance sheet, assets and liabilities are the head, and then they get broken down. The two most important sections of the assets are current assets, and those are everything that the company can pretty much sell off either during the 12-month period of operation, or at least within 12 months, right? And then there are the non-current assets, which take longer than 12 months to sell off. Then you have, similarly, liabilities, which are the debts. And current liabilities are those which the company either has to pay within a 12-month period, or at least in 12 months. And the non-current liabilities, actually non-current liabilities, sorry about that. Non-current liabilities are those which fall outside of the 12-month period. So they don't have to pay that within 1 year, pretty much, right? Additionally to that, value investment, from the books I've read again, there have been two specific additional current assets that are taken into account. And they are cash and cash equivalents. That's actually how it's either listed, or it's listed as cash in hand or on hand, I believe it is. And the next one is inventories. And we're gonna come across shortly why, right? And this is why. With the information that I've gone over, I've just given before, basically value investors like to pull out some ratios. We like to calculate ratios. Yes, I know ratios. If you ever heard the term or you did the term back in high school and maths, it was the devil or whatever. Nobody liked it. But these ratios are actually pretty simple. It's really and truly from what I have found, in my own opinion, it's simple maths. It's actually just addition, subtraction, division. And once you know the formula for the ratio, you're on your way. I haven't found any complexity. So even if you feel like you're overwhelmed, as I said, once you look up the particular terminology and the information is presented to you, especially from Investopedia, because I did a lot of my research outside of my books when the books got too confusing from Investopedia. These ratios became very comfortable to me. And more so, what we are looking at here becomes very repetitive. So I want to go back over again. You're gonna see assets and liabilities when you deal with the balance sheet. And further breakdown to assets and liabilities, you're going to be focusing on current assets and non-current assets. Similarly, you're going to be focusing on current liabilities and non-current liabilities. And then you're also going to pull out two additional current assets in that are labeled cash and cash equivalents, or cash on hand or in hand, however it's written, and inventories. And from there, you're going to then proceed to, or I proceed, I should say, to doing these ratios, right? Now, let me back up for a second. The ratios identify, from what I've seen, the strength of the company at the financial position being given. So there are two types of ratios. The first one is liquidity ratios, and this might be technical. You really don't need to remember it as that. But for those of you for those members here who might have actually gone to the JSE investor forum that they held down at it was a workshop for a day, I think it was, that they held down at their place downtown. Sorry, they actually gave us a sheet in the more advanced class, and they broke out these ratios. Really don't need to know it, but it's just to, or should I say, know it this way, it's just a good to understand, because they tell you basically what the companies has to pay off currently based on their current debt. That's what the liquidity ratios are. And then I'll get to the other one shortly. So we're dealing with the liquidity ratios, which deals with the company's ability to pay off its current debt. And remember, current debt is that which is going to more than likely be due within either the year, some point in time in the year, or at least at the end of the year, right? So they are the current ratio, the quick ratio, and these are terminologies that you will hear. So you can focus on them. You don't have to remember it now, but you should remember hearing about them. And if you want to write them down, just remember them, because these are very powerful ratios when you do them, and you'll see why in the end. And the third one is the cash ratio. So the next, let me just, I don't want to jump forward. I want to do one thing first in the explanation, so I'll come back. So the current ratio. The current ratio measures the company's ability to pay the short-term obligations, debt, as I said, within the 1 year. It's also termed working capital ratio. So you might hear that terminology as well. So if you hear it, it's the same thing. Current ratio, working capital, same terminology. And the formula for it, and remember I said, this is just maths, simple maths, add, subtract, divide. The formula is your current assets, that's the total current assets, divided by total current liabilities. The next one is the quick ratio, or they call it the acid test ratio. And I mostly hear it as the acid test ratio. And that is really a further breakout or breakdown of the current ratio. But remember, I told you guys that you should be looking to extract the cash and cash equivalents, or cash at hand and inventory. And this is the reason why for the asset test ratio, we want to remove the inventory from one of these indicators here and in the formula. And that is, we want to remove the inventory from current assets. And why is that so? Because not all inventory can be sold off within a 12-month period, during or at least in a year. Things can happen to the company and they are left back with inventory and it goes over into the next financial cycle, year, etc., quarter. So this is a more precise ratio when we look to do value investing, the acid test ratio, right? And it is arrived at by first taking away inventory from current assets and then dividing the result by the current liabilities, right? And then the last one is our cash ratio. Now, in my reading, I found that this is not a ratio that really the companies keep in a heavy amount of, or high. It's not high, because normally companies try to utilize their cash. They don't keep a lot of cash. But I found that it actually tells, if you do the ratio, it actually can give you some insight into a company deciding to make moves. For instance, they might be thinking about buying a factory, or they might be thinking about expanding, right? Or they might need to cover debt that is coming up. So this particular ratio starts to show you where the company is preparing for something to happen. When you start to see it, I believe, increasing like that. So yes, it's dealing with debt, as it says. It is the ability to pay short-term debt with cash, or near cash, what they call resources, but really is what is near cash. When you look on the balance sheet, you'll see those things in terms of what are the current assets that are there. Things like well, property, plant, and equipment is long-term assets. But well, the inventories, as it says, the list is the inventory. But yeah, off the top of my head, I can't remember it, so apologies. But later on, I'll remember. I'll tell you guys. So from that, you have, this is the formula in which it is the cash and cash equivalents, or cash on hand, divided by the current liabilities, right? And having a good ratio, having a good indicator for this ratio is showing a company's, again, all of these show a company's strength, right? So the next section has to do, going back a little bit, sorry, has to do with solvency ratios. And again, you don't need to remember the term. You just need to remember the ratio. And that deals with both short and long-term debt that the company has, or takes on, right? And how that debt is a part of either assets, so how much of the debt makes up assets, or how much of the debt makes up your equity as a shareholder, right? So, for instance, debt to asset is how much of debt makes up the assets of the company, whereas debt to equity is how much of that debt makes up your shareholder equity, and if you have anything to get. So you know that if debt has ballooned above these amounts, you really don't have anything to get should the company, God forbid, have to wind up, right? So better explanation of them. The debt to equity ratio, it shows the company's debt makeup, and as I explained it just now, it is debt against you, the shareholder, your equity, your stake in the company. And that formula is basically total debt. You can call it total debt, but normally it's total liabilities. So it's all liabilities divided by total equity, or total shareholder equity. And remember the term shareholder equity. And debt to asset ratio is, as I said, is that portion of debt that makes up assets. That formula is, again, is total debt, or the total liabilities, divided by the total number of assets. So again, you see, it's simple maths, straightforward maths. There's no big formulas. Just once you know the ratio, you just need to write it down. It's add, subtract, multiply, divide. That's all you're doing, right? And then the last one, for me, this one actually is very important. It's called the financial leverage ratio, or what is termed the equity multiplier, right? And why I term it important, and I definitely know why the books that I've read term it important, is because it is basically showing you how much of the company's assets is financing shareholders' equity, which is money to you. And you really want that to be in a good position, right? So that formula is simple again. It's total assets divided by total equity, total shareholder equity. So give you a little snippet there. The next slide that I'm going to go to is, in my view, based on what I've read, how it comes together, how the magic starts about value investing. So all of those formulas that I've just gone through, assets, liabilities, current assets, current liabilities, well, those are not the formulas, those are the actual terminologies. And then the equity, shareholders' equity, and then the ratios, right, that were listed: cash ratio, current ratio, the acid test ratio, and these other ones that are listed here. The magic in them, as I said, as stated earlier, we as value investors look at trends. We like trends. So we extract those numbers from the company's financials, from the balance sheet, and we try to chart them. So for all you who are very good at Excel, this is going to be great for you. For those who don't know Excel or don't know Google Sheets, well, it's going to be a bit difficult for you to write down all the numbers and formulate a table. So I would really strongly advise you guys, if you're all on smartphones or tablets or computers, so definitely you're tech savvy enough to be here. So yes, you should do a little course, and they're free courses about how to use Excel, more fluidly, where you can use the formulas, etc. But what comes together, what happens is simply this. This is a company. I'm not going to name the company, but this is a company. And this is the simplicity of putting everything together year on year for that particular company. And you notice, again, as I said, there are many things in a balance sheet, but I'm only focusing on a certain set of information for now. You do not see, by the way, the ratios in a balance sheet, so you can forget about that. You have to calculate that yourself. But these things are in a balance sheet. The first 5 are in a balance sheet. They're all listed: current assets, cash and cash equivalents, current liabilities. And apologies, I left out the asset test ratio from this one. So, but you get the picture. You can actually get the picture of seeing it from here. So when we put everything together on a chart, right, in a sheet, and total assets is a combination of the total current assets, current liabilities, total assets is non-current assets and current assets together, giving that total. So just add this. Just add the current, non-current assets and current assets together, and you get total assets. Similarly, for the liabilities, you just add the non-current liabilities together to the current liabilities, and you get the total liabilities. And then equity, well, equity is found by just subtracting these two from each other. And as you notice, I'd mentioned the term debt. So total debt, well, I like to use the term. The term is actually not there, but total debt is total liability. So it's basically putting back that figure again. And from there, as you remember how the calculations go, I'm going to go back. Let's look on the first one. Debt to equity is not the first one. It was debt to asset. But the debt to asset ratio, the formula was total liabilities are total debt divided by total assets. And as you can see, debt to asset ratio down here, that's that formula that is being done. I'm just simply dividing the total debt by the total assets. Now, as I said, the beauty and the magic of it is that there are some thresholds for these ratios. Everybody has their own thresholds. I use mine, and I have heard that the use of ratios are normally best, at least I've heard for Jamaica, when they're describing it in Jamaica, we do a comparison between, we like to compare companies, or in terms of a company's competitor, or we like to compare the company to the industry average, and so forth. Well, for me as a value investor, the books that I have read have given me clear-cut ratios. They're very high, to be very honest. The thresholds for the ratios are very high. But it states these companies should be able to stand on their own 2 feet. Because inherently, if they have these ratios at this level, at that level, for the thresholds that I'm using, it means at least at the start of their performance, at their balance sheet level, they're in good standing, right? So you'll notice for this company, the cash ratio was never really that high until about June 2017, right? Their financial year. And this is the financial year, as I said, so let me restate that. But then come June 2018, when that financial year ended, it went positive. And it's gone down a bit in June 2019, but it's still positive, right? Similarly, for all of the other ratios, thresholds that I'm using, it's all green, with that slight area there in the current ratio indicator for June, for the financial year 2017 June for the company. What is even better, while these are just numbers and it might get confusing looking at numbers and you're not sure, because this looks good. This is green in 2018. Everything is green in 2018 and 2019. We take it one step further, and this is what Excel does. And you'll learn this. In time, you will learn it. This. Remember I said, value investors love trends. So we then draw a trend line of how this particular company might perform. And with these trends, and we do this for each financial statement. And as I said, I'm only going through the balance sheet in depth now because time will only allow for that. But each statement trends, or should I say, there are ratios for them, and there are trends, there are charts, graphs that we develop. And it is simple to do so. An Excel course can teach you this. There's nothing difficult about it. There are no funny formulas or whatnot. As I said, it's straight division, multiplication, addition, subtraction, right? But this now gives us, when we put all of these charts together and the trend, we can tell, okay, how does this company look going forward? Is their debts to their assets increasing? Yes, it is. Is it intended to increase? Yes. So you notice, even though the company, when you chart the numbers and the thresholds I'm using is green, when you put it on a trend graph, a different picture is illustrated or shown. And now you have another decision. So you're constantly scrutinizing as a value investor. You want as much information as possible to make your final decision, right? So this is what, in what I've read, they do. This is what I've had to adapt. It didn't start, funny enough, in 2015 when I started, actually, to be very honest. The putting it together like this really only came together about 3 years ago, because for the first 2 years, I really was learning what all these concepts were and reading about them and trying to understand the definitions better and the numbers better and the formulas better. And then when I put them on the chart, because some of the books that I read have these graphs and charts in them, I then understood, oh, that's the next picture that is formed when it's done, right? So we recap that we have gone through ratios, we have gone through the balance sheet and the ratios connected to the balance sheet. These ratios are just for the balance sheet, by the way. And we've gone through the key elements that I look for in the balance sheet to arrive at those ratios, right? And again, apologies for not having the asset test ratio in there, or quick ratio as it's called. I forgot to put in, because of this particular company, it actually doesn't have inventories in there. So it's not there, but you get the picture that this is what forms. And when you read, for instance, if you looked up debt to equity ratio in Investopedia, it actually tells you what is, by American standards, an acceptable ratio, right? And a number that you're looking at. So 0.08, basically, ratios was 2 to 1 or 3 to 1. So anything that is 2, right, is 2. In the way how they put this, they wanted it to actually be going up for it to be positive, which means that the debt is not making up a lot of the equity, basically, right? There's more equity than there is debt. So as you notice, the numbers, take for instance the current ratio. It means that current assets divided by current liabilities, or that means that current assets is way more than current liabilities. 2.11 is 2.2 times more assets than liabilities, or 7 times more assets than liabilities, right? Vice versa for the debt to equity ratio, though, it has a reverse in that you want that coming down. So unfortunately, this company was actually going up a bit in their debt to equity ratio, but it was still within my threshold that I use. Now there is, as I said, there are thresholds for these things. You will have to choose your own. But my threshold still saw this company as being in a positive light. But I was able to know still that at least it's still going up. So I need to be cautious and I need to be aware of that. And I need to be, and at least during the year of 2018 for June to 2019, it looked like it was starting to stop going. It was starting to taper off, plateau as they call it, and stop going up and level off now. And hopefully for the 2020 period, when the company puts out their financials, 2020 year, it will be coming down. Hopefully, we will see, right? But the trend is that it's going up. So really and truly, I know where it's. I can, with reasonable assumption, I'm going to use the trend line, that dotted line that is there, to say that it's going to continue to go up. Now, I want to link the balance sheet to the stock market of the company. Well, the balance sheet of the company to the stock market. This is what you guys always hear about every single day. So another part in the balance sheet that you will see, or you'll hear it. I don't really see it listed. So it's sometimes listed, not all the time. But the shares outstanding for the company, and that's the total. You hear that term every single time we have an IPO. Total number of shares outstanding. Well, the shares outstanding is the number of units of stock that the company is going to put out, right, to prospective shareholders to buy. Now, that particular term and the figure behind that term is very important, because it's what is used to calculate the, it's what's used in conjunction with for the market price, basically, and how the market price comes out or is calculated. But we'll get to that in a little bit. Some other terminologies that you might hear: market capitalization of the company. Basically, that is the cash value of the company shares outstanding, right? So for instance, if one share costs $10,000, right, then the market cap of the company is 10,000. You would see that on when they talk about the company. And then this terminology, the earnings per share, basically is the earnings of the company, and we'll talk about that shortly. But you guys always hear it as net profit, net income. So it's the earnings of the company to each of those shares that the company puts out. So it's the earnings that each share that you hold is valued at. So when you see $14 per share in earnings, it means that your one share is valued $14. This particular one now is another terminology. It's not there. It's a calculation that is done, and it's called the book value. And this is a very, very important term and a very important formula. It's the company's share value, or per share value, that is taken from shareholders' equity, your money to you, back to you. And the formula is basically total shareholders' equity and it's the shareholders' equity that you saw in the balance sheet divided by what they list as the total shares outstanding. Now I won't even get into there. This can get very confusing in terms of how shares outstanding is referenced to. You'll learn it further when you read, because you have to read, right? As I keep saying, reading is going to be fundamental. But as simply as I can break it down, it is total shareholder equity, which you know is in the balance sheet, divided by what you see as the total shares outstanding. And I'll make an illustration for you guys quickly. Let me show you. So this is 138 student living. This is the Jamstock X. Here you go. Shares outstanding, 1.2 billion shares. And the market value, which is the dollar value of those shares, this would be 1.2 trillion, 1.1 trillion. Basically, if you round it off, it's 1.2 trillion dollars there, right? So these terms, you're going to see them constantly. So you shouldn't be afraid of them. You will hear, and after a while, you can constantly hear them. You can constantly understand. You just need to understand what they mean, right? And move forward from there. So the book value is the most important part of the company. Why? For us as value investors. Why is that so? Because that's the cost of the company. That's the cost of the company of one share of the company, right? So when you're looking to buy the company, if you're paying a particular price for the company, just know that if you were to calculate the company's book value, you go in there, you find the shareholder equity number, and then you find the shares outstanding, and you do this calculation. Whatever number you come up with, you put that to the number that you see being sold for the stock market, for the company by its stock price that day. You know at that point in time, well, this value says the company is valued if they were to sell off, right, everything. This is how much the company is valued at on a singular share basis, and I'm willing to pay 6-7 times for it. All right, I really have to make a real serious decision. Does this make sense to pay 6-7 times for the company over this actual value of the company? And this book value term, you notice at the start of if you remember, jog your memory back, there was the terminology used, intrinsic value. This is the intrinsic value, at least by Investopedia standards and by the books that I've read that reference to Warren Buffett, is the intrinsic values general breakdown. The book value is in the intrinsic value of the company. And it's a very important indicator to remember. And the formula is very important to remember, right? So moving forward, for the income statement, I'm not going to get into it, but I'm going to extract 2 items from it because it sets up the link to the stock market and what you guys hear every single day, right? So the income statement, as I told you what that is, just basically it shows the company's profitability. And from the income statement, there are 2 line items there, straightforward. There's revenue. As I said, that's what the company has generated over its operations for the period that it's being listed in the income statement, quarterly or yearly. And net income. So net income can either be net profit or net loss, or it can actually be labeled as net income. But that is what is left back when expenses are removed from revenue. All the expenses, whatever expenses you see, is removed from the revenue. Now, an explanation, a better explanation now for earnings per share that you saw. Earnings per share is obtained when you take the net income from those total shares outstanding. And earnings per share, as you can see, again, is the company's earnings, right? It's net profit, it's net loss on a per share basis. So basically, for every share you are holding, it's how much either it is a loss or a profit to you. As I said, and the example I used was $14. If it's $14 earnings per share, it means it's $14 of basically profit. Or if it's negative, then it's $14 loss for each share that you are holding in the company. And again, we come back to the book value, and I want you to, and I state it again because it's important, right? About what it is and the formula again. So we're gonna get to the fun part now. Again, another fun part of what you guys always hear about in the stock market. You always hear about PE and price to book value and book value. What do those things mean? So first, let's start with the price, the PE, as they call it, or the price to earnings ratio, right? It's the dollar amount that the investor can expect to get back after a company's financial year is completed 1 year later when they've invested. So for instance, it is basically if you invest X amount of dollars, you can expect that by investing X amount of dollars, you should receive $1 in the company's earnings by the end of the year or a year later, pretty much, right? And you're gonna see this, see how important this is in short order. So remember this term. You're always going to hear it. So remember what it means. It means every dollar amount that you invest in the company, you should be expecting that you're going to receive $1 at the end of the company's financial or a year later. Right? Similarly, price to book value or book value is the company's book value when compared to its market price. Now, the market price is the terminology that you hear about all the time on the stock market. Or the company's market price is 28 or 150 or whatever it is. And the market price is the amount you are willing to pay in comparison to its book value. And that ratio, when you divide the market price by the book value, tells you that for every dollar that you have spent purchasing this stock, you should expect 1 year later $1 in shareholder equity back. So you see the importance, you should see the importance now of shareholders' equity and why that term and that figure is so important to you, and you want to be aware that it is rising and increasing and so forth. That is not bad. That is a good thing. But too much debt will sink you, sink any company, right? So there's a price to book value, and that's the formula: market price, which you're gonna hear a lot, divided by the book value. So the last term is specific to value investors. It's called a margin of safety. And this is the Investopedia's definition of it, basically, where, it is our principle of investing where we only purchase, the term is securities, actually, when you purchase stock. Securities is everything, though, not just stock, it's stock, bonds, everything. When I did the Jamaica Stock Exchange securities course this year, it taught me, it opened my eyes so much to what securities really are, and not just the stock market alone. Stock is but one security. So it is marginal safety is basically us trying to purchase the stock, since we are talking about stock, at a significantly low value, as in it's being sold at a discount. And in its simplest form, marginal safety is basically multiplying price to earnings ratio, or PE, by the price to book value. You get a figure from that. And that figure is what we, based on the margin of safety, is what we use when we see a company. So we might see a company, because what you're really going to see, you're not going to look up a company. You might look up the company's balance sheet and so forth. But more than likely, where you're going to start from is the company's financials. And let me show you where you're going to start from. I love using their sites because I think it is very informative. This is not a plug for anybody. It's just that their information is nicely laid out. So Mayberry does these trade sheets every single day. I'm sorry, 1 second. I need to shut this down so that I can actually get it. So Mayberry does these trade sheets every day. Now, for those of you who invest, those of you who have some stock, those of you who get those reports from your respective broker every single time. This is normally what you see with some more information. But the main thing is you have the company name and the company identifier. You have the price that the company closed at for the day. You're gonna see PE, here it is. You're gonna see price to book, and then you see some other stuff. So let's focus. This is really what you see. And we're only focusing on PE and price to book, right? And this is the market price here. Close price is market price, right? Our last traded price, it might be termed as well too. But I won't bother to explain. You can ask me later on for those who want to know fully. There's a difference between last trade price and close price. We use the close price. So close price is market price, right? That is the price you or some investor are willing to buy or sell the company for. This price is not linked at this point. More than likely, it's not linked to the actual book value of the company, right? So we use this, again, going back to my presentation, we use that information to arrive at our margin of safety. And that's where the market price is used in order to arrive at the price to book value, right? So basically, this is an extract that I took from the Investors Podcast, What is Value Investing? Because they broke it down pretty simply. So imagine you have an entire business, and the business basically reports that it made $20,000 in net profit, right? And they say that the market price of the business, basically, or the overall value of the business, is 100,000. That's how much the business is willing to sell itself for if they were to wrap up. That's not really the book value. That is what the business is willing to sell itself for. When you break those two numbers down into a per share basis or a singular value, you get net income, which is the big number, turns into earnings, which is a smaller figure, which is $2. So the earnings is $2 for every share that the company has out. And the market price, basically, it means that inherently, it means this company actually has 10,000 shares, right? Basically, what you're seeing here, the fact that the market price is $10, it means that the company has 10,000 shares, $10 by 10,000, right? So for the company, when you take the net income and the market price, and you remember the price to book value, you divide the market price. Well, sorry, it's not the price to book value. It's the earnings per share. Sorry, so PE ratio that we're looking at. When you take the market price and you divide the net income out of it, you get a figure, right? And that figure, the reciprocal of that figure, well, basically, if you take it, it would be 20, as expressed as a percentage is 20%. So normally PE, this is actually a little additional information. The PE ratio, the number for the PE ratio, if you divide it by 1, which is termed the reciprocal, if you divide it by 1, that figure is known as your return on investment. And that is that figure here at the bottom. So really and truly, it's actually net income divided by market price, which is 1/5. And that expressed as a percentage is 20%. Same thing over here now. We take that big value and we break it down to a per share basis. So you have a question that you should ask yourself. Based on if you can buy a company for $100, should you really buy a company for $100? Similarly, a company that is selling for $2 and you say, yeah, man, I can buy a lot of it. Should you really buy that company after you've analyzed it? Is it really selling for as close to or below its book value, right? Because we want returns. So when you take away the net income from market price, you get your return on investment, the reciprocal of it, 1 over the number. And that's your return on investment. That's what you should be expecting in 1 year. So as Lisa said, yes, I'm a Buffett fan, right? He goes into the the video from the guys went in further to look on how to actually, what does PE really mean, right? So you have this now. So we've taken away and we've broken down the market price and the net income, as you can see before, into per share, each share, a per share basis. And this is what you see every day. You see a P of 2 or a P of 10. What does it really mean, right? So you notice it has, for a P of 10 where the market price is 10, if you divide it by its earnings, you get a number that is 5. And as I said, the reciprocal of that is the earnings. So it means 1 over 5 expressed as a percentage, 1/5 expressed as a percentage is 20%. And from there, this is actually Buffett's own methodology. He said basically, from there, we know that these numbers over here, 5, 10, 15, 20, 25, this is the type of return that we should be expecting in a year. So the higher that the PE number goes, is the less return you're going to get, right? Because 5 is 20, 25 is 4, right? Moving further into it now, we move from the PE and what that represents, and we go into the price to book value. Same thing again, we have the market price this time, and you guys know the book value. You've done the calculation, so you know the book value. So this book value example is 70 cents. That means the company on a per share basis is valued 70 cents. And you are about to pay $10 for this company as their stock price. When you divide the stock price, market price from the book value, you get another number, and that is the price to book value number. And as again it says, for every $14.3 that you are spending, you're supposed to get back $1 in book value from the company, in that equity from the company in a year. And what does that mean? That means that you are setting yourself, you see the term safety on the other side? Safety is the amount of risk that you're taking. So when you decide to buy a company whose market price is so far out from the book value, you are buying a company that does not have, by the fundamentals, by the financials that they actually put out, the level of equity, shareholders' equity, to support that price, right? But that's not all bad. Sometimes it depends on where you want to get in. So Buffett then went on to state, just like with the PE ratio, as you saw, the same number 5, you do the reciprocal of safety now. If you put 14.3, 1 over 14.3, you recognize that that's not even there on that chart on the right hand side. It stopped at 5. So that means that for every time that number goes up higher, your safety, your share of equity gets less and less, right? So putting the two together, because as I said, margin of safety is price to book value times PE ratio. Buffett has devised, and you'll find this out standardly. Now, this is the big part about value investing. Another big part, because there are many, is patience, and is the ability to stick to what you believe in. When you put the two together, right, you're trying to put the market price together with the earnings, together with the book value. Really and truly, that is the PE ratio and the price to book value. And you notice you have your return that you expect is 4%. And then you have safety of 20% for the number. So for the number 5, where the PE ratio is 5, and if the price to book value is 5, you get a you get a return of investment at 20, but you get a safety, shareholder equity of only 20%. Whereas if you're getting a PE of 5 and a price to book value of 0.7, you're getting a huge amount of shareholder equity safety of 143%. So basically, when he puts that together, what he decided to do is he looked for a threshold, and you guys are going to get this is one of the big gems of value investing. The threshold that he looks for, and I always tell my group, the number is 22.5. Why is it 22.5? Because we want a PE ratio of 15. This was based off the American economy where interest rates are low. So we want a PE ratio of 15 where our return is going to be about at least 6.6%. No higher than that. And then we want a price to book value. He actually goes at 1.5. That's the number he's looking for, which means that the shareholder equity safety, or the safety from the earnings, right, is 67%. Right? Now, when you do the calculations, you're gonna see this. You're gonna see this jump up and down. You might actually have a company, by the way, and you'll see it. You'll have a company that has a high PE but a low price, but a low price to book value, and it might actually give you a margin of safety of 22.5. And you might think, oh, I mean, I'm within the range, within the threshold. But being within the threshold is actually seeing everything line up. So for me, just like you saw on my balance sheet, I have a green highlight. When both price to earnings and price to book line up within this threshold, that's when I decide, okay, this looks like I want to make a move in terms of I need to be looking at this company further. I need to start analyzing this company, right? So, and as you see, it was actually in the presentation. When you take it, I hope you all actually look at these videos. When you get to this particular video, you'll remember, you'll see it, knowing it when you see it, that this is a company I need to look at, right? So to recap, we went through, I showed you the balance sheet. I showed you parts of the income statement, two most important parts I extract, and how the balance sheet and those parts of the income statement are linked to the stock market. We went over the terminologies, so I want to just go back quickly. Forgive me. Let's go with it. So we know that we need to remember shares outstanding, right? We need to remember book value. It's very important in terms of what that means and how that is arrived at. Because that's how much the company is really valued. And if you're going to pay on the stock market for more than that for it, you better be certain. It's not to say that you're not going to buy it, but you really need to be certain that you are going to be getting that $1 of every share that you own back within the year, right? You want to be comfortable about that at night. So the ratios that you know, and how they're broken down, and I showed you how the business, this is the whole business, and then how the business is broken down in a per share basis, right? And then how Mr. Buffett and every value investor that follows him basically tries to deal or value a company via the analysis by putting together, by marrying the price earnings number to the price to book value, right? In order to arrive at this threshold, which is 22.5, right? So I'm gonna take it out for a second. Let's move out and go. Let's go back to that sheet quickly. So let's take 138 student living. The current PE ratio. And for those who were, I'm going to bring up my calculator, guys. I quick maths is not my thing. Blame it on technology. So the PE ratio is 7.43. And the price to book value that is currently there is 0.043. Sorry. Times 0.43. That gives this company a margin of safety of 3, which is really good in terms of how the price, in terms of the market price to its book value. But that don't mean that you must buy the company. That's just where we're going to start analyzing the company. And that's where we're going to start looking at the balance sheet, as I showed you, and start looking at all of its assets versus all of its liabilities. And we're going to calculate those ratios and see if the company is really on sound financial standing. And when we put all of those things together, and with the price, the margin of safety looking like this, then I might decide to take a decision to go in, right? But outside of that, this is not an indicator to just start saying, oh yes, I'm going to buy the company. No, it's just a starting point, right? So let's do it again. Let's go again. Let's take another company. I want something that is really out there. Let's see what stands out. And again, this is not an indictment against any company, people. This is just taking companies at random and what the figures are actually being represented as, right? Let's take, I want high figures again, as I said.
We have a vote for NCB.
G's and P's, really? Actually, you know, the joke about that is NCB's margin of safety is actually down right now. You want to know why? And this is why I was saying to you, how do you know if you want to buy a company at $100 or shy away from a company that's $100? Because I mean, that's how your money can stretch, right? Versus buying a company that costs $2, where you know you are of the belief that, yeah, man, your money can really stretch. So let's look at NCB since the vote is that. PE ratio for NCB is 12.58. PE ratio and the price to book is 1.91. So yes, it is over the margin of safety by about a little bit, by about two. And normally I play around with this now, and I'm gonna use a statement that I learned from somebody later on when I'm ending my presentation. Why I use that. Not that I'm an expert. I am not in any way. I'm still learning, but I believe that I have come to a point where I understand the recipe, right? And I can add my own ingredients now to the recipe to start playing around with it. So, vote was for NCB. NCB is not that bad by margin of safety standards. Yes, it's over, okay, but it's not egregiously over. What is egregiously over is, let's take for instance, Pulse, right? That's 24, so that's 24.05 times 6.32. That's 151. What kind of safety are you looking at buying a company that is 6 times over its book value? Notice that number is not even there. So that means your safety is not even here. Goodly zero, right? Your price to book goodly is zero. And definitely at 100 and 151, there is no margin of safety for something like that, at least at the current price that it is at the current price, right? And that is what value investors seek to do. We seek to identify where this marries together. And I will say this, at some point in time, given the patience, these prices, whether the prices are 388, by the way, or not, these prices actually do come back to margin of safety. It could actually still be 388, but because of new company financials that have been put out for maybe a new quarter or for the end of the year, when the new figures come in, when you do the margin of safety, and if the stock price has stayed the same, the stock price hasn't moved, it might actually now be in margin of safety. I've shown my group how that happens, or has happened in the past, right? Always. Like there's a point when the company falls back into margin of safety. And it is at that point, if you've been investing in the company, then I'm telling you that I would like to state that value investors buy more. We buy more. We've taken our profit when the company gets way out of range at 151. If I had invested in Pulse at 173, when they had stock split, and I think the price came down to 173, and I was still holding, and now their price is at $3.88. I'm selling it and taking my profit. And then I'm going to wait for it to basically drop back within margin of safety. And I'm going to come back in again and buy at whatever price, at what that price is that I'm comfortable at, right? And I won't have a problem paying 388, because at that point in time, it's telling, based on this information that I've done, it's telling me that the company, I should analyze it further. And if the company's financials line up where all of those ratios are really looking good, yes, I will take a chance in it. Me personally will take a chance in it, because everything has lined up. the analysis of the financial information has lined up, the margin of safety has lined up, so and the market price is suitable to me. I have the ability to do so. So going back to my presentation, and this basically finishes it. Margin of safety and book value are the two most important things us as value investors look at. Every book so far that I have read, this is what it speaks of. All of the persons following Benjamin Graham was the first person. Buffett is his protege. That he basically came after. They all follow the same thing, and I intend to do the same. And the only thing that you have that you will have to learn, everyone, is patience, right? But it's patience that once you get it right, you're confident. Like every time somebody is buying, you're leaving. Like when there's the big noise about people buying stuff, buying stocks, you're leaving. You knew it was going to happen, or at least you had all indicators that should say this is more than likely to happen. So with that being said, again, that's the end of the presentation. And I did say that there's a philosophy that I learned. It was stated from someone who is their mentor, and it was actually stated by David Mullins, who I follow and have great respect for. His mentor is Michael Lee Chin, and the statement was, you learn the recipe, which is why I said I use the recipe. You learn the recipe, you practice the recipe, and not until you have mastered the recipe do you try to change the recipe by adding your own stuff. So there ends my presentation. I really hope that you all have, especially for my group, every single time they've heard me talking about this, they are now more aware of these terminologies that I keep using, and they keep seeing, because you guys are going to see this all the time, right? You're going to continuously see this on every sheet. The moment you buy a stock and you sign up for that broker newsletter that they send, this is the terminologies you're going to run across, right? And see it all the time. And you need to know what you're looking at. So I thank you guys for your attention. And the floor, I think we should be going into question and answer at this point in time. So I'll hand it back over to Jeremy.